Welcome to ACCA Academy channel. Share consideration is a critical concept in financial reporting that can significantly impact a company's financial statements. In this video, I will explore what share consideration is, how it is calculated, and its implication for financial reporting. From understanding the accounting treatment to disclosure requirements, I will cover it all. Let's dive into the topic. What is share consideration? Share consideration is when a company issue its own shares as consideration for shares acquired from the subsidiary company. Instead of the parent company to pay the shareholders of the subsidiary company in cash, they may issue part of their own shares as a consideration for shares acquired in subsidiary company. The parent company will issue part of their shares to the shareholders of the subsidiary company as a consideration for share acquired from the subsidiary company. That consideration is called share consideration or share exchange. Share consideration or share exchange or share exchange. They are exchanging their own shares. The parent company is exchanging its own shares for the subsidiary shares. That is why it is called share exchange. So, how is this measured? So, it is usually valued at the market price of the parent company, of the parent company. So, you value the share exchange using the market price of the parent company. So in this case, 3 accounts will be affected. 3 items will be affected whenever share exchange or share consideration is involved. Number 1, we have share exchange. Share exchange valued at market price of the parent. So, the market price of the parent may be greater than the par value of the equity shares of the parent company. So, if it is greater, that means we can divide this market price into 2. The par value and the premium. Where the market price is greater than the par value, it means this market price will be shared into 2. We have the par value and we equally have the premium. 3 different accounts will be affected. Number 1, the market price of the parent. And I said the market price will be divided into 2, the par value and the premium. So for the purpose of goodwill, the purchase consideration that will be used in calculating goodwill will be number of share exchange. Number of share exchange, that is the number of share exchange. Number of share exchange is the number of shares the parent company agree to issue their own shares in exchange for the subsidiary shares. That is the number of shares the parent company agree to allocate to the shareholders of the subsidiary in exchange for shares acquired. So that is number of share exchange. Number of share exchange times market price of the parent. Market price per share of parent company. This will give you the purchase consideration that will be used in calculating goodwill on acquisition of subsidiary company. Number 2, the par value. The par value of share consideration. The par value of share consideration should be added to the share capital of the parent. Be added to the share capital of the parent company for consolidation purpose. The share capital, the par value of share consideration, the par value of share exchange will be added to the share capital of the parent company for consolidation purpose. And the premium of share consideration or share exchange will be added to the share premium of the parent for consolidation purpose. So we can raise a journal for these three accounts. So if you want to raise a journal for them, so you have journal. So you debit purchase consideration, I've told you the purchase consideration. To value the purchase consideration, you have the number of shares exchange times the market price per share of the parent. Value that market price per share of parent. Credit share capital. That is, you credit the ordinary shares with the par value of share consideration, and you credit the share premium with the premium. The premium will be the difference between, that is, the market price per share of the parent minus the par value. So the difference between the market price per share of the parent minus the par value of the parent equity shares, that will be the premium. And we only give the format of the items affected by the share consideration. Every other concepts in group account I've examined in my previous videos are still relevant. Remember, the first step is to draw the group structure. Then the second step is the summary of the subsidiary net asset. The third step is to calculate the goodwill on acquisition of the subsidiary, then followed by the calculation of retained earnings, and then we have the non-controlling interest. Then you prepare the consolidated statement of financial position. So now the format now, goodwill on acquisition. So you could have purchase consideration, which may comprise cash consideration, loan notes as consideration. You could have deferred consideration. Then you may have share consideration. My focus in this video is on share consideration. Then the example I will solve from the past exams questions will equally involve the loan notes consideration. Then deferred consideration will be examined in another video. So these are different forms of purchase consideration. Then you have the NCI at acquisition. NCI at acquisition. Remember, the valuation of NCI depends on the group policy. Depends on the policy of the group. So then after that, you subtract the fair value of net assets at the date of acquisition. Fair value of net assets at the date of acquisition, you arrive at goodwill. And if there is any impairment loss will be subtracted. If goodwill is impaired, that means the amount of impairment loss on goodwill will be impaired. Remember how to value the share consideration? I've told you that the share consideration will be valued at the market price per share of the parent company. Then the second item that is affected is ordinary share. Ordinary share that will appear in the consolidated statement of financial position will be parent ordinary share as per statement of financial position. Then you now add the par value of share consideration or share exchange. You add the par value. So this will be the ordinary share that will appear in the consolidated statement of financial position. The third item is share premium. The share premium that will appear in the consolidated statement of financial position will comprise the parent company share premium as per statement of financial position. Then you now add premium on share consideration. You add the premium on share consideration. Then you get the value of share premium that will appear in the consolidated statement of financial position. Let's take a comprehensive work example. Keep watching. Example. This question is obtained from ICAN May 2022 financial reporting question number 3. Daddy PSC is a first-tier entity quoted on the Nigeria Stock Exchange, NSE. The entity acquired 460 billion equity shares in Mommy PSC on 1st of January 2020. The purchase consideration comprised the following. 1. Issue of 1 ordinary shares of Daddy PSC in exchange for every 2 shares in Mommy PSC. Note 2. Issue of 100 naira 12% loan notes in Daddy PSC in exchange for every 400 shares in Mommy PSC. And 3. A cash payment of 15 kobo per share for every shares acquired in Mommy PSC on 1st of January 2020. At the date of acquisition, the market price of Daddy PSC share was 75 kobo each. The cost incurred by bank when the fixed rate loan is paid out early is assumed to be nil. Also, Daddy PSC has recorded the 12% loan notes in the purchase consideration in the accounts. The statements of financial position of the two companies as at December 31st, 2020 are presented below. We have Daddy PSC, Mommy PSC, amount in billion naira. Assets, starting with non-current assets. Property, plant and equipment, 650, 350 for Daddy and Mommy. Investment, 160 and 0. Intangible assets, 0 and 40. Non-current assets is totaled 810 and 390 for Daddy and Mommy respectively. Current assets, we have inventories, 125. Trade receivables, 190, 70. Bank, 0 and 35. Bank, we have current asset total 290 and 130 for Daddy and Mommy respectively. Total assets 1,100 and 520. Equity and liabilities, which include ordinary shares at 25 kobo each. Daddy 350, Mommy 200. Retained earnings on 1st of January 2020, Daddy 220, Mommy 130 and 120. Retained earnings at 31st December 2020, Daddy 100, Mommy 50. Then the equity of Daddy is totaled 670, while that of Mommy is totaled 370. We have non-current liabilities. 12% loan notes, Daddy 160, Mommy 40. Current liabilities, trade payables, Daddy 150, Mommy 60. Other accrued expenses, Daddy 40, Mommy 20. Current taxation, Daddy 50, Mommy 30. Bank, Daddy 30, Mommy 0. The current liability total, Daddy 270, while that of Mommy is 110. Then we have total equity and liabilities, Daddy 1,100, while that of Mommy is 520. Then additional information. 1. As at the date of acquisition, the carrying amount of the net assets of Mommy PLC was equal to their fair value, except for an item of property which had a fair value of 50 billion naira in excess of its carrying amount, with additional depreciation of 5 billion naira in the post-acquisition period to March 31st, 2020. Then we have, this has not been reflected in Mommy PLC statement of financial position. Note 2. The intangible asset was a television program designed to promote the business activities of Mommy PLC. However, as a result of new government legislation on security matters, on banditry and criminalities, such television programs have now been pronounced illegal in the country. The appropriate government security agency advised the company to immediately stop the television program, and 12 billion compensation is to be received from the television authority. As a result of the new legislation, the governing board of Daddy PLC was of the opinion that goodwill on consolidation has been severely impaired by 30 billion naira. Note 3. We have, it is the group's policy to value non-controlling interest at full fair value. The fair value of non-controlling interest as at the date of acquisition was 100 billion naira. Note 4. Mommy PLC sold goods worth 20 billion naira to Daddy PLC during the post-acquisition period. 5 billion of these goods were included in the inventory of Daddy PLC as at December 31st, 2020. Mommy PLC made a profit of 8 billion naira on these sales. Note 5. Mommy PLC trade payables of 9 billion naira did not agree with Daddy PLC trade receivables as a result of cash in transit of 5 billion naira. You are required to prepare the consolidated statement of financial position as at December 31st, 2020. Solution. So we want to prepare the consolidated statement of financial position for Daddy PLC group. So the name of the entity is Daddy PLC group. So we have consolidated statement of financial position as at, so the year end is December 31st, 2020, as at December 31st, 2020. So we want to prepare the consolidated statement of financial position for Daddy PLC group. Amount is in billion naira and billion. So we start with the assets. The first asset to start with is non-current assets. Non-current assets. So we have opened the financial statements we want to prepare. So we can start by drawing the group structure. You were told, now let's have workings. Let's say working one, working number one. So we have group structure. I've told you the first thing is to draw the group structure. But let's go through the question. Are we given the percentage of acquisition? Of course, no. Because you were told the entities acquire 50 billion equity shares. The number of shares acquired is what you are given. You are not given the percentage of acquisition. So you will need to calculate the percentage of acquisition. Percentage of acquisition. We say percentage of acquisition equal to number of shares acquired, which is 650 billion shares, over total number of equity shares of the subsidiary. If you have watched my earlier video on consolidated financial statements, the introductory lecture, I've given you the formula for calculating the group structure or percentage of acquisition. I tell you that the percentage of acquisition is number of shares acquired from the subsidiary over total number of equity shares of the subsidiary times 100, and that will give you the percentage of acquisition. What if 650 billion shares were acquired? What is the total number of shares of the subsidiary? Now, let's go through the statement of financial position under the equity section in order to ascertain the total number of shares the subsidiary had in the period. Under the equity section, you have ordinary shares at 25 kobo each. Subsidiary is having 200 billion shares. And this is the value, the nominal value of subsidiary share is 200 billion. You know the par value is 25 kobo. So what you need is not the nominal value, is the number of shares of the subsidiary. And to get the number of shares of the subsidiary, you divide the nominal value of the shares by the par value. So you know the nominal value is 200 billion. 200 billion divided by the par value, which is 25 kobo, 0.25. So this will give you, if you multiply by 100, it will give you the percentage of acquisition. So it means 200 billion divided by 0.25, that will give us it will give us 800 billion. 200 divided by 0.25, that gives us 800 billion. That means percentage of acquisition. We have 640 billion over the denominator gives us 800 billion times 100. So that gives us 640 divided by 800, that gives us 80%. That's 100. It gives us 80%. Therefore, the percentage of shares acquired by the parent company from the subsidiary company is 80%. Now that you have known the percentage of acquisition, then the next thing is to draw the group structure. Let me have working number 2. Working 2, we have the group structure. So it means Daddy PLC. We have Daddy PLC acquires 80% of the equity shares of Mommy PLC. What is the date of acquisition? January 1, 2020. That is the date of acquisition. On 1st of January 2020. So, and you are consolidating. You are preparing the consolidated financial statement on December 31st, 2020. That means the acquisition is during the year. Now, after the group structure, I told you the second step is to present the summary of subsidiaries' net assets. Now, working number 3. Working 3, we have summary of the subsidiary is Mommy PLC net assets. So, as usual, we used to have a column for the post-acquisition retained earnings, post-acquisition retained earnings. Retained earnings. Amount is in billion naira. We used to have another column for date of acquisition. Amount is in billion naira. We equally used to have date of consolidation. Amount is in billion naira. So as usual, we used to go through the equity section of the subsidiary statement of financial position in order to ascertain the components of equity that are provided. So if you go through the equity section, we have ordinary shares and retained earnings. Ordinary share, ordinary share. Subsidiaries ordinary share amounted to 200 billion. So we have 200 billion, that is DOC, 200 billion. After ordinary share, then we have retained earnings. Now, how much is the retained earnings of the subsidiary? Two retained earnings are given. One is occurring on 1st of January 2020, and the other one is at December 31st, 2020. That means we have 120 billion plus 50 billion. So the sum of 120 and 50, that gives us 170. The accumulated retained earnings of the subsidiary as per the statement of financial position is 170 billion. Remember, subsidiary was acquired on 1st of January 2020. How much is the retained earnings as at that date? So 1/1/2020, that is 120. That is to show that the pre-acquisition retained earnings of the subsidiary, that is the retained earnings of the subsidiary at the date of acquisition is 120. That is pre. So your equity shares will always be 200. So ordinary shares, what you have in DOC, same value will be recorded in the DOA. Now, how much is the post-acquisition retained earnings? 200 minus 200, ni 170 minus 120. Then the post-acquisition retained earnings amounted to 50 billion naira. Now, let's go through the additional information in order to ascertain the items that will require adjustments in the equity section of the subsidiary statement of financial, that will require adjustments in the summary of subsidiary net assets. So the first item, we have additional information. As at the date of acquisition, it means the information here we have fed the DOA, because you have as at the date of acquisition. It shows that the information we have in note 1 are occurring. The information there are occurring at the date of acquisition. Therefore, adjustment will be required in DOA, date of acquisition. DOA means date of acquisition. The carrying amount of the net assets of Mommy PLC was equal to their fair value, except for an item of property which had a fair value of 50 billion in excess of its carrying amount. We have a properties with fair value of 50 billion in excess of their carrying amount. So we have fair value gain. Fair value gain on property 50 billion in excess of its carrying amount. So same amount will be in DOA. Remember, it will be in DOC as well. It occurs at the DOA, date of acquisition. That is why it is recorded under DOA. Remember, DOC is just a memorandum column. It's not part of the double entry. So carrying amount with additional depreciation of 5 billion in the post-acquisition period. So we have additional depreciation. Additional means extra depreciation of 5 billion in the post-acquisition period. 5 billion additional depreciation, and that will require adjustment in post-acquisition profit. Since the depreciation you are given is up to 31st of March 2020, that means the depreciation you are given is for a quarter. That is January, February, March, just a quarter of the year. And that depreciation is 5 billion. And remember, we have 4 quarters in a year. If one quarter ended in March, go back to that note 1. If the first quarter ended in March, another one will end in June, another one in September, while the fourth one in December, making 4 quarters in a year. So we have times 4. So the additional depreciation will be 20 billion. Remember, we were told it relates to post-acquisition period. Now that we've calculated the depreciation, remember the fair value gains of 50 billion will be added to the PP, and the 20 billion depreciation will be subtracted from the PP. Now, how much will be the value of the property, plant, and equipment in the statement of financial position? So now let's have PP, consolidated statement of financial position. So we have for that is 650 billion. For mommy, 350 billion. We have fair value gains of 50 billion. Depreciation of 20 billion. So that will amount to 650 plus 350 plus 50 minus 20. So we have 1 trillion and 30 billion. Note 2. The intangible asset was a television program designed to promote the business activities of Mommy PLC. You have an intangible asset. We were told it's a television program. However, as a result of new government legislation on security matters on banditry and criminality, such television programs have now been pronounced illegal in the country. Since the television program that gave rise to intangible assets has now been pronounced illegal, that means the intangible assets you have recognized before will need to be derecognized. From the statement of financial position, we have intangible assets of 40 billion. And these 40 billion that have been recognized as an intangible asset in the statement of financial position of the subsidiary will need to be derecognized. So to derecognize it, that means we remove it from the financial statement. So we have intangible assets of 40 billion. Remember, if you want to derecognize it, that means you want to remove it. Asset have a debit balance. So that means we need to credit the intangible asset in order to eliminate it from the financial statement. Then, if you credit the intangible asset, then you debit the retained earnings. So to debit the retained earnings, it means you reduce the retained earnings by the amount of that intangible asset. The recognition of that intangible asset relates to post-acquisition period. So that is why we are removing it from post-acquisition retained earnings. We have derecognized the intangible asset because the programs that give rise to that intangible asset have been pronounced illegal. So that is the reason why it was derecognized. It was adjusted in the post-acquisition profit because there are no information in the question that any of the intangible asset relates to pre-acquisition period. So the appropriate government security agency advised the company to immediately stop the television program, and 12 billion compensation is to be received from the television authority. Now they will receive compensation of 12 billion naira from the television authority. No, this is some planned program. It's a contingent asset. Of course, at the beginning of the question, you were told intangible asset. This asset was created as a result of the compensation that was received. And it's related to post-acquisition period, since there are no information in the question to show that there are any of it that relates to pre-acquisition period. So we will create a contingent asset. So if you recognize a contingent asset, you debit the asset, then you credit the retained earnings with the 12 billion naira. As a result of the new legislation, the governing board of that DPLC was of the opinion that goodwill and consolidation has been severely impaired by 30 billion. So impairment loss of 30 billion will need to be recognized as well. But what is the policy? I've told you the treatment of the impairment loss depends on the group policy. It is the group policy to value not controlling interest at full fair value. So since it is fair value, that means we will adjust for impairment loss in the summary of subsidiary net assets. So adjustment will be made in the summary of net asset. I've told you sharing it between the retained earnings and NCI. If policy is fair value, you can carry out the adjustment in the summary of subsidiary net asset. But if the policy is proportionate share of subsidiary net asset, you won't use it in the subsidiary net asset, but you will only subtract it from the post-acquisition retained earnings or consolidated retained earnings. Then the second leg of it will be adjusted in goodwill. But now that the policy is fair value, so you subtract it from goodwill, that means you are crediting the goodwill, then you debit the retained earnings. That is, it will be subtracted from the adjusted post-acquisition profit of subsidiary in the summary of subsidiary net asset. We subtract the 30 billion there. So that is the treatment of the impairment loss. So two adjustments is required: a contingent asset of 12 billion that has been created. So because compensation will be received. So if it will be paid, that means liability, it is liability that will give rise to payments. But this one will be received. That is an asset. But if it is payment, it is the liability that will give rise to payment. The entity now is receiving a compensation. So the compensation received is a contingent asset. Is an unexpected asset. So it's a contingent asset. So we recognize the contingent asset. After you debit the asset, you credit the retained earnings. Impairment loss too will need to be adjusted. So we have fair value of contingent asset. Fair value of contingent asset. So we have that to be 12 billion. So you debit assets, you credit retained earnings. So if you are crediting the retained earnings, that means you are adding it to the retained earnings. So that is why we have it as positive. Then we also have impairment loss. Impairment loss of 30 billion. So the retained earnings will be reduced by the amount of the impairment loss, 30 billion. From note 4, you were told that Mommy PLC so goes what? 20 billion to Daddy PLC during the post-acquisition period. Who is the seller? Of course, the Mommy PLC. Remember, Mommy PLC is the subsidiary. And I've told you that where subsidiary is the seller, the unrealized profit will need to be adjusted in the summary of subsidiary net asset, since subsidiary is the seller. But where parent is the seller, you won't need to adjust for the unrealized profit in the summary of subsidiary net asset. Now, you were told the item transfer is 20 billion, and during the post-acquisition period, 5 billion of these goods were included in inventory of Daddy PLC as of December 2020. So 5 billion is still in the inventory. That means the unrealized profit will be calculated on the 5 billion that is still in the inventory of Daddy PLC. So you were told Mommy PLC made a profit of 8 billion on the sales. The amount of profit made on these sales has been given to be 8 billion. That means the unrealized profits to be calculated will be 5 over 20 times 8 billion. So we have provision for unrealized profit, 5 billion out of 20 billion transfer times the profit of 8 billion. So this will give you the amount of the unrealized profit. 5 times 8 divided by 20. So you have the unrealized profit to be 2 billion. So that will be adjusted. So you subtract it from the adjusted post-acquisition retained earnings. After this adjustment, how much do you have as the total? So we have 200 plus 170 plus 50 minus 20 minus 40 plus 12 minus 30 minus 2. So you have 340. 340. Then 200 plus 120 plus 50, that is total 370. 370. Then 50 minus 20 minus 40 plus 12 minus 30 minus 2. There you have minus 30 billion. This is negative. You have 30 billion negative. Remember, to calculate goodwill, we need the purchase consideration. We were told that the PLC is a first-tier entity quoted on the Nigeria Stock Exchange, NSE. The entity acquired 640 billion equity shares in Mommy PLC on January 1st, 2020. The number of shares acquired is 640 billion. I might need the 640 billion later, but I want to rub it off now so that I'll be able to do some workings there. The purchase consideration comprises the following. So you are not given the information about the purchase consideration. You were told it comprises of the item listed below. So working number 4. Working 4. We want to calculate goodwill on acquisition of Mommy PLC. Goodwill on acquisition of Mommy PLC. To calculate goodwill, you need purchase consideration. Purchase consideration. Now, what are the purchase consideration given in this question? So, you were told, note 1, issue of 1 ordinary shares in Daddy PLC in exchange for every 2 shares in Mommy PLC. So, this is a share exchange. So, we have share exchange or share consideration. Note the number of shares acquired is 640 billion, which I've rubbed off. So, Daddy now 640 billion shares, which was acquired. Daddy will give the shareholders of Mommy 2 shares in place of 3. 2, that is issue of 1 shares in place of 2. Issue of 1 ordinary shares of Daddy PLC in exchange for every 2 shares in Mommy PLC. 1 for 2. 1, they will receive 1 share in place of 2 shares. 1/2. That means the number of shares they will get in return in total will be 320 shares. So the shares that they will get will reduce since the shareholders will be given 1 share in place of 2 shares acquired. And I've told you to value the share consideration. You will need the market price per share of the parent. It is the parent's price, the market price per share of parents you need, not that of the subsidiary. So you were to issue of 100 naira 12% loan notes in Daddy PLC in exchange for every 400 naira shares in Mommy PLC, and a cash payment of 25 kobo of 15 kobo per share for every shares acquired in Mommy PLC on 1st of January 2020. So you have, at the date of acquisition, the market price of Daddy PLC share was 75 kobo each. And I've told you that it is the market price of the parent you need to value the share consideration. Now that you have seen the market price to be 75 kobo, so you have times 75 kobo. Now you convert kobo to naira. 100 kobo make 1 naira. So we have 640 times 1 divided by 2 times 0.75. So that gives us 240 billion naira. So that is the value of share exchange. Share exchange, the value is 240 billion naira. Then we also have another consideration in note 2. Issue of 100 naira, 12% loan notes. Then we have loan consideration, loan notes as a consideration. So issue of 100 naira 12% loan notes in Daddy PLC in exchange for every 400 shares in Mommy PLC. 400 shares in Mommy PLC. How many shares were acquired? 640 billion. They will be given 400 shares. 400 shares. Yes. So issue of 100 naira 12% loan notes in Daddy PLC in exchange for every 400 naira shares in Mommy PLC. No, they acquire 640 billion shares from mommy. So they be given 400 shares as a loan note for 100. That is times 100 naira. 100 naira loan notes. 640 divided by 400 times 100. That gives us 160 billion. That is low consideration. That is note 2. Note 3. A cash payment of 15 kobo per share for every shares acquired in mommy PLC. For every shares acquired in mommy PLC on 1st of January 2020. So you also have cash consideration of 15 kobo per shares for every shares acquired. You know the shares acquired is 640 billion. And you'll be paid, they will be paid 15 kobo. 15 kobo for every shares acquired. So 640 times 0.15. That gives us 96 billion. So that is the third consideration. These are the three considerations provided in the question. So if you sum them up, plus 160 plus 240. So the consideration is totaled for 96. For 96. So that is the cash, that is the total purchase consideration. After the purchase consideration, the next item to consider is the non-controlling interest. In the note 3, towards the end of the note 3, you were told the fair value of non-controlling interest at the date of acquisition was 100 billion naira. So towards the end of additional information number 3, before you get to additional information number 4, before you get to additional information number 4, you were given the fair value of non-controlling interest. Fair value of NCI of non-controlling interest at the date of acquisition. You were given that to be 100 billion. So if you add this, you have 596. Then, after that, we used to subtract the fair value of the non-controlling interest at the date of acquisition. I mean, fair value of net assets. Fair value of net assets at the date of acquisition. Then you go back to the summary of the subsidiary's net asset. We got that to be 370 billion. So 370 billion, that is the fair value of net assets at the date of acquisition. 370. If you subtract 370 from 596, we have 596 minus 370. So we have 226. 226. After this, we have impairment loss. Impairment loss. The impairment loss is given towards the end of the additional information number 2. So note 2, towards the end of note 2, you will see the impairment loss there. So, and that is given to be 30 billion. If you subtract the 30 billion from 226, then you have 196 billion. So now that we've arrived at 196 billion as the value of goodwill, you can go ahead and post that to the consolidated statement of financial position. Goodwill, that is from working number 4. We have that to be 196 billion. After goodwill, then we have investments, and these investments are being used as part of the consideration for the acquisition of the subsidiary. So then the next item is intangible assets. So we have intangible assets. Parent 0, subsidiary we have 40. 0 plus 40. Remember, the intangible assets of the subsidiary have been derecognized because the program that led to the recognition of the intangible asset have been declared illegal. So because it has been derecognized, so we remove it. So that means the intangible asset will be nil. So the non-current assets is total 1030 plus 196. We have 1226. 1226. After the non-current asset, we have current assets. So as part of our current assets, the first item we have is inventories, 125. Inventories, 100 billion for parents, subsidiary 25 billion. Remember, there is a trading activity between parent and subsidiary that led to the recognition of unrealized profits of 2 billion. If you go back to the summary of subsidiary net asset, you will see the unrealized profit of 2 billion, the calculation of 2 billion, how we arrive at 2 billion. You will see it there. So 100 plus 25 minus 2, that would be 123 billion. Then after the inventories, the next asset is trade receivables. We have trade receivables. Parent trade receivables amounted to 190 billion. That of subsidiary is 70 billion. 190 plus 70. Then back to the note. From note 5, you were told Mommy PSC trade payables of 9 billion naira did not agree with Daddy's PSC trade receivables as a result of cash in transit of 5 billion. You know it is a payable to the parent, to the Mommy PSC. Mommy PSC is owing Daddy PSC. When Mommy PSC remitted the cash of 5 billion, Mommy PSC will have reduced her liability with Daddy PSC. So it means what that Mommy PSC was owing Daddy PSC before was 14 billion. But after the payment of 5 billion, Mommy PSC will have reduced the amount he's owing from 14 billion to 9 billion by subtracting 5 billion from 14 billion. That is why Mommy PSC still assumed that she is having a trade payable of 9 billion. That is, she is still owing Daddy PSC the sum of 9 billion. But since this 9 billion hasn't been received by Daddy PSC, you know, Mommy PSC is recording a payable of 9 billion. But Daddy PSC hasn't received the 9 billion. That means Daddy PSC will still assume that Mommy PSC is owing him the sum of 14 billion. So being 9 billion plus 5 billion. Daddy assume Mommy is still owing him the sum of 14 billion since Daddy hasn't received the 5 billion that was sent by Mommy PLC. So as a result of that, the receivable of Daddy PSC still contain the sum of 14 billion, not 9 billion. The reason for the disagreement is as a result of cash in transit. So it is 14 billion that will be subtracted from receivables. That is 9 billion plus 5 billion, which is 14 billion. So we remove that from receivables. So intergroup receivables will be 190. Trade receivables will be 190 plus 70 minus 14. That gives us the sum of 246 billion. So trade receivable amounted to 246 billion naira. After trade receivables, we have bank. Bank. For Daddy PSC, we have 0. And for Mommy PSC, we have 35. So it's 0 billion plus 35 billion. Then remember, we have cash in transit. I told you the cash in transit will be added to cash or bank balance. So that means you'll be having the sum of 40 billion naira. Then there are no other current assets left. But remember, we have contingent assets earlier, which was given in note 1 about note 2. So do we have contingent assets? Yes, note 2, where we have the intangible assets. So the contingent asset, we said it will be recognized. So contingent assets. Contingent assets of 12 billion will be recognized. You know, we have recognized the intangible assets of 40 billion and contingent assets of 12 billion was recognized. So if you sum up the current assets, you'll be having 1, 2, 3 plus 246 plus 40 plus 12. So current asset is totaled 421. That is total current assets for 21 billion naira. So we now have total assets. Total asset will comprises the total of the non-current asset, if that is A, and the total of current asset, if that is B. That means total asset will be A plus B. So we have 41 plus 1226. So we have 1647. That is total asset, 1647 billion. So 1,647 billion naira. So that is the total assets. After total asset, the next section is equity and liabilities. As part of equity, we have ordinary shares. Ordinary shares. And ordinary shares, let's have that as working number 5. So we are not using the ordinary shares of the parent only, since there are share consideration. There are information about share consideration in the question. So working number 5. Ordinary share. Ordinary share. It is in billion naira. So the ordinary shares of the parent, that of Daddy PSC. Daddy PSC, ordinary share. So we have the ordinary shares of Daddy PSC to be 350 billion. So we also have par value of share exchange or share consideration. No 640 billion shares were acquired. So for the ratio is 1:2, as given in the question, times what is the par value of the shares? So 225 kobo. 25 kobo. That is the par value. So 640 divided by 2 times 0.25. The par value of share exchange is 80 billion. So if you add the 80 billion to 350 billion, then you have 430 billion. That is the ordinary shares that will appear in the consolidated statement of financial position. Ordinary share, we have that to be 430 billion. Then after ordinary share, we have share premium. Share premium. Let's have that as working number 6. Working number 6. Share premium. Daddy PSC doesn't have any share premium. Daddy PSC does not have any share premium. There is no share premium under equity. We have premium on share exchange. Premium on share exchange. You know, To be able to value the premium on share consideration, we need the market price per share of the parent. You were told a cash payment of 15 kobo per share for every shares acquired in Mommy PLC on 1st of January 2020. So this is cash consideration. Since we did not subtract this, since it hasn't been recorded, we ought to have subtracted this from cash balance. We know when payment is made, cash will leave the entity. You credit cash, so you debit cash consideration. You debit the consideration transfer. That is the double entry for that. Since you have not credited the cash, so you can add it to the bank balance. Since we have bank balance under the current liability, so you can apply that alternative treatment. At the date of acquisition, the market price of that PSC share was 75 kobo each. So we can see that. So the market price per shares of the parent company is given to be 75 kobo each. Therefore, the premium now will be, the market price is 75 kobo minus the par value of parent company shares is 25 kobo. So that means you are having a premium of 50 kobo times how many shares were acquired? 640 billion shares were acquired in ratio of 1 to 2. So we have 640 divided by 2 times 0.5. That gives us 160. 160. That is the premium on share consideration. And this premium will be recorded in share premium section of the consolidated statement of financial position. It will form part of the equity. So we have 160 billion. Then after this, the next item is retained earnings. Retained earnings. Let me have this as working number 7. Working number 7. We have retained earnings. Amount is in billion naira. The starting point is the retained earnings of the parent, which is Daddy PLC retained earnings as per statement of financial position. So under the statement of financial position, the retained earnings of Daddy PLC was split into 2. The one on 1st of January 2020, which is 220 billion, plus retained earnings as of December 2020, which is 100 billion. So 220 billion plus 100 billion, that will be total 320 billion. Then the next item is Daddy PLC share of the adjusted post-acquisition retained earnings of Mommy PLC. So Daddy PLC share of adjusted post-acquisition retained earnings of Mommy PLC. The percentage of acquisition as calculated earlier from working number 1 is 80%. Now then, in the summary of Mommy's PLC's net asset, we arrive at the post-acquisition retained earnings of 30 billion negative, which is loss of 30 billion. So that means that the PLC will receive 80% of the 30 billion, which is a loss. Let me put minus 30, since it is a loss. 80% of minus 30, that will be minus 24. If you subtract minus 24 from 320 minus 24, that you'll be left with 296. That is the amount of retained earnings that will appear in the consolidated statement of financial position, we have 296. So you can sum up that in order to get the equity attributable to the owners of that PLC. So we have 886. 8, this is 6, 15, 18, 886. Then after that, the next item will be non-controlling interest. Non-controlling interest. Let's have that as working number 8. Working number 8. Non-controlling interest. Towards the end of note 3, or even in note 3, we were told that the NCI is valued at fair value. Fair value of NCI at acquisition. So you were told in note 3 that NCI is valued at fair value, and towards the end of the note 3, you were told the fair value of non-controlling interest as at the date of acquisition was 100 billion. So you have 100 billion as the fair value of NCI. Then you now have NCI share of adjusted post-acquisition profit. NCI share of adjusted post-acquisition profit of Mommy PLC. No, that they acquired 80% of Mommy. That means NCI owns 20% of Mommy. And we got minus 30. 20% of minus 30, that will be minus 6. If you subtract 6 from 100, you'll be left with 94 billion. So the NCI is valued at 94 billion at the date of consolidation. 86 plus 94, then you have 980. 980. That is the total equity. After total equity, the next item will be non-current liabilities. We have non-current liabilities. So non-current liabilities, we have 12% loan notes, 160 billion and 40 billion for Daddy and Mommy respectively. 12% loan notes, 160 plus 40, that is totaled 200 billion. That is the only non-current liabilities we have. Then the next section we have current liabilities. Under this section, we have trade payables, 150 and 60. Trade payables, we have 150 plus 60 minus, remember we have integral payables, which was given in note 5. We have integral payables. In note 5, you were told Mommy PLC trade payables of 9 billion did not agree with Daddy PLC trade receivables. So, trade payables, integral payables of 9 billion. Then, we subtract the integral payables of 9 billion naira. So, minus 9 billion. This is 210 minus 9. Then we have 201. After trade payables, as part of the current liabilities, we have other accrued expenses, 40 and 20. other accrued expenses. 40 for daddy, 20 for mommy. That is total 60 billion. Then we have current taxation, 50 for daddy, 30 for mommy. Current taxation, 50 plus 30. That is total 80 billion. Then we are still on current liability section. We have bank. Bank is 30 and is 0. Bank 30 plus 0 plus cash consideration. You were told the cash payments of 15 kobo per share for every shares acquired in Mommy PLC on January 1st, 2020. I've told you this payment may either be debited to consideration and credit cash, or since under current asset we did not credit cash, so you can add it to bank overdraft. No, if you debit the consideration, you credit bank overdraft. Bank overdraft will have a credit balance, which is liability. So of course, if you add it to it, so it doesn't make any difference. So 50 kobo per shares acquired. So remember, the number of shares acquired from the beginning of the question was given to be 640 billion. So 50 kobo of that 15 kobo times 640. $50 of 640. 15 kobo of that gives us 96. 96 plus 0 plus 30. That is totaled 126. So we have 126. You can first of all add the current asset before you add equity and liabilities to and the non-current liability to it. But because of the space, I want to put the total equity and liabilities. 126 plus 8, 80 rather, plus 60 plus 201 plus 200 plus 980. We have 1647 as the total. 161,647. That is the total equity and liabilities. Total equity and liabilities. You will see that the total equity and liabilities agrees with the total asset of 1647. Both total equity and liabilities and total assets are the same. So this marked the end of the solution to this question. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ACCA.